Every monetary system on Earth eventually reaches a point where it can no longer sustain itself. The United States is no exception. The dollar is currently propping up more than $35 trillion in public debt, in an economy that depends on creating ever more money to service ever larger debts. But herein lies the terrifying paradox. If the system always needs to print more money just to survive, when does it ever stabilize? The answer is never. Because when you look deep into the history of the USD, you realize it was designed to reset periodically. And the reset is not a bug in the system. The reset is the system itself. Over the past 110 years, the United States has gone through three major resets. In 1913, the creation of the Federal Reserve's centralized monetary control in one institution. In 1933, the government ended the domestic gold standard, stripping citizens of the right to exchange dollars for gold in order to revalue the USD during the Great Depression. Then in 1971, the Nixon Shock ended the international gold standard, turning the dollar into a currency backed purely by faith and policy. Each reset happened when the system hit its limits and had to be restructured to survive. A money reset is not about changing physical currency or wiping money away. It is about changing how the dollar is created, circulated, and valued. Sometimes it happens through policy like QE or QT, sometimes through the dollar losing purchasing power, and sometimes through new technology like CBDC or FedNow. So why is the next reset inevitable? With public debt exceeding $35 trillion, persistent inflation eroding the dollar's value, bank reserves at critically low levels, BRICS pushing de-dollarized trade, and election cycles demanding stability at any cost, the system has once again reached its natural limits. What is coming is not a sudden accident. It is the next chapter of a design that has lasted a century, and when the numbers can no longer lie, a reset is what the system is forced to do. The years 2020-2025 were a chain of shocks that in hindsight clearly pushed the U.S. economy straight to the edge of an unavoidable money reset. It all started in 2020, when the pandemic forced the country into lockdown, millions lost jobs and thousands of businesses shut down. To keep the economy from plunging into a deep depression, the government and the Federal Reserve launched the largest QE package in American history, pumping roughly $6 trillion into the system in a very short time. That flood of money didn't just stimulate spending, it inflated the value of every asset class. Stocks soared, even while the real economy stalled. Crypto exploded at an unprecedented pace, and real estate prices skyrocketed thanks to record low interest rates. From the outside, Americans felt like they were getting richer, but that wealth was just the illusion of cheap money, not based on productivity or real economic growth. By 2021, as the economy reopened, all that excess money turned into inflation. Prices for goods and services rose faster than policymakers had predicted, creating the highest inflation in over 40 years. From gasoline and food to healthcare, insurance, and everyday services, everything became more expensive. Workers' wages did not rise fast enough to keep up with the cost of living, so real incomes fell sharply. This was the period when many Americans first felt they were working harder yet getting poorer. To fight inflation, the Fed had to act aggressively. From 2022 to 2023, it raised interest rates 11 times at the fastest pace most Americans had ever experienced. The rapid rate hikes sent a shock through the entire financial system. Businesses faced higher borrowing costs, while ordinary people were essentially priced out of the housing market as mortgage rates climbed to 7–8%. The real estate market froze, buyers couldn't afford to buy, and existing homeowners refused to sell because they didn't want to lose the ultra-low rates they had locked in during the cheap money era. As living costs kept rising faster than median wages, households came under growing financial pressure. The savings that had ballooned during the stimulus check period were quickly depleted. By 2023-2024, many people started relying on credit cards just to cover basic expenses, pushing consumer debt past the $1 trillion mark for the first time ever. Americans were living more on debt than ever before, while their real income kept shrinking. At the same time, the breakthrough development of artificial intelligence profoundly changed the labor market. AI began replacing office jobs, customer support roles, and basic data analysis positions, the very jobs that made up much of the working and middle class. Although AI boosted corporate productivity, those gains did not flow to workers. Instead, people lost income, career prospects, and faced the real risk of permanent replacement. This widened inequality and made the economy even more vulnerable to shocks. Meanwhile, the bond market started reacting strongly to the Fed's policy shifts. As rates rose and inflation persisted, investors demanded higher yields to hold government debt. that increased the government's borrowing costs and put additional strain on the financial system. Confidence in the sustainability of the national debt weakened significantly, leaving the government in an increasingly difficult position as it tried to fund spending with debt at rising interest rates. When you connect all these factors, massive QE, asset bubbles, prolonged inflation, the interest rate shock, a strangled housing market, record consumer debt, AI-driven job displacement, and mounting pressure on the credit system, they paint a clear picture. The U.S. economy had been stretched beyond its limits. None of these events were random. They were the signals of a monetary system reaching its natural ceiling. When a monetary system is pushed to the point where it can no longer self-correct, only one outcome remains: reset. That is why 2020-25 was not just a period of turbulence. It was the preparation phase, the catalyst, the spiral that drove America straight toward the next money reset, where the entire operating mechanism of the dollar will have to be restructured so the system can survive another cycle. Against the backdrop of all the economic pressures that piled up from 2020 to 2025, the Federal Reserve entered what economists call a policy trap, a situation where no matter which direction the Fed chooses, the system gets hurt. The most dangerous part is that this trap wasn't created by any single policy decision. The modern U.S. economic structure itself has locked the Fed into a corner with no exit. After the aggressive rate hikes of 2022-2023, the Fed moved into sustained quantitative tightening (QT) from 2022-2024. QT shrinks the Fed's balance sheet by reducing its holdings of bonds, meaning less money is pumped into the system. But that unintentionally drained liquidity from the banking system faster than expected. Bank reserves fell to their lowest levels since 2020. Smaller banks struggled to meet withdrawal demands and short-term funding needs, while larger banks tightened lending standards out of liquidity risk concerns. When liquidity dried up, the entire economy started to slow. Business lending dropped, mortgage lending dropped, consumer lending contracted, and when credit tightens, the economy cannot grow. This left the Fed in an extremely difficult position. In theory, it had three options, but all three were bad. Option 1, keep rates high to continue fighting inflation. But keeping rates high for too long would soon push the government into a debt crisis. With over $35 trillion in federal debt and more than $1 trillion in annual interest payments, the U.S. government simply cannot function if borrowing costs keep rising. High rates would push the government to the brink of technical default, something that cannot be allowed to happen because the USD is the world's reserve currency. Option 2, cut rates quickly to stimulate the economy and relieve pressure on banks. But cutting rates too fast would bring inflation roaring back almost immediately. Housing prices, food prices, service prices, everything would shoot up again as people borrowed and spent more. That would undo 2 years of anti-inflation effort and further erode confidence in the dollar. Option 3, leave rates where they are. But that is arguably the most dangerous choice because it would leave the economy in a state of living dead. Small and medium businesses would face borrowing costs too high to expand. Commercial real estate, already under pressure from remote work, would slide into a liquidity crisis, triggering waves of loan defaults. A collapse in commercial real estate would deal severe damage to the banking system, especially regional banks that are heavily exposed to commercial loans. Because all three paths are losing propositions, the Fed is cornered. Any move carries serious consequences. This is the clearest manifestation of the policy trap. The Fed cannot stay on the current path, but it also cannot change course quickly without negative repercussions. So what will force the Fed to pivot by the end of 2025? First, the government needs bond buyers. With debt growing rapidly, the Treasury has to keep issuing bonds to fund spending. But if rates stay high and the Fed doesn't support the bond market, investors will demand even higher yields, pushing debt service costs to unsustainable levels. That forces the Fed to ease QT and resume supporting the Treasury market. Second, the banking system needs liquidity. Prolonged QT has drained bank reserves to the point where banks can't lend and can't stabilize their balance sheets. The Fed will have to reverse course and inject liquidity again, or the credit system will seize up and cause a recession. Third, the public needs indirect relief through lower rates. Skyrocketing living costs, record credit card debt, and falling real incomes have exhausted American households. An economy where consumers can't spend is an economy that can't grow, and the Fed knows it. When the government, the banks, and the people are all under simultaneous pressure, the Fed cannot stand still. And this is where the mathematical reality of the system reveals an undeniable truth. When debt service costs outpace economic growth, the only option left is a reset, The reset isn't something the Fed wants. It's something the numbers no longer allow any other solution to survive. When the Fed is cornered by the very system it is trying to preserve, the most important thing Americans need to understand right now is this: the reset is no longer a future prediction. It has already begun. A monetary reset is never officially announced with a speech or a national television address. It happens through signals, through quiet changes that spread throughout the economy. And if you look closely enough, three of the clearest signs are already visible in everyday life and in America's financial structure. The first signal is that the dollar is losing purchasing power much faster than official CPI numbers admit. From 2021 to 2025, food prices have risen steadily, with many items up 20–40%. Healthcare and insurance costs have soared to the point of becoming a burden, not just for the working class, but for the middle class as well. Services, from haircuts and car repairs to childcare, have all gotten dramatically more expensive. These are not normal fluctuations, they are structural price shifts. And the scariest part is that even when wages rise, they don't rise fast enough to offset the currency's loss of value. People earn higher nominal incomes, but are still getting poorer. Spending power falls. Saving becomes nearly impossible. Homeownership is out of reach for most. When the real value of the USD collapses, that is already a silent form of reset, a reset of the money in every American's wallet. The second signal is in Treasury securities, the heart of the US financial system. For decades, T-bills were considered the safest investment on earth, but the 2022–2025 period saw something unprecedented. Treasury yields spiked in ways never seen before. This is how the market sends the signal that the government now has to pay far more to borrow money. When yields rise, it means investors are no longer willing to buy bonds at low interest rates. They demand higher compensation for higher risk. Even a temporary loss of confidence is extremely dangerous in a system where the entire government depends on borrowing to function. When investors demand higher yields to hold US debt, it is a clear sign that the fiscal and monetary system is losing balance and must be restructured. No country can indefinitely sustain debt that grows faster than GDP without hitting a limit. And when that limit appears, a reset becomes unavoidable. The third and most important signal about the future of the USD is the rise of CBDC and FedNow. Many people view CBDC as some kind of conspiracy, but in reality, it is not a conspiracy. It is the technical foundation for the next generation dollar. FedNow has already been rolled out as a 24/7 instant payment system, something the US was years behind other countries on, and a CBDC, if implemented, will not be about abolishing traditional money. It will be an infrastructure upgrade, much like email replaced paper mail. It is faster, more transparent, more controllable, and suited to an era where transactions happen in milliseconds. What few notice is that every monetary system in history has first been restructured through technology before being restructured through policy. Technology changes the plumbing, then policy changes the rules. FedNow and CBDC are the technological signs that the coming reset will not just be a policy tweak, it will be a complete rebirth of the dollar's architecture. When technology changes how money works, the entire financial system changes with it. And when the dollar's value is falling, when bonds are volatile, when the government needs new mechanisms to manage liquidity and borrowing costs, the reset is no longer a question of if, but of how far along it already is. These three signals, loss of purchasing power, abnormal treasury volatility, and the emergence of CBDC/FedNow, are not isolated events. They are three different arrows all pointing in the same direction. The system is rebuilding itself. Once the reset signals are plainly visible in everyday life and in the financial markets, the most important question is no longer will the reset happen, but who wins and who loses in this monetary restructuring. A monetary reset has never been fair. There are always winners and losers because the essence of a reset is a transfer of value, a silent redistribution of wealth that most people don't notice until it's too late. And in today's America, the biggest losers are precisely the people the system claims to protect, yet who get hit first and hardest. Cash holders top the list. As the dollar loses purchasing power over time, every dollar in a wallet, bank account, or savings fund quietly weakens. Holding cash during a reset is no longer safe. It is risk. Each dollar is silently eroded by inflation, shrinking the real wealth of these people even though they did nothing wrong. In the same group are savers who don't invest, those who believe saving alone will secure their future. But during prolonged inflation and an active reset, savings that don't outpace inflation mean losing money every year. When inflation runs 5–10% and savings accounts pay 1–2%, savers are actually getting poorer without realizing it. Next are people who rely solely on fixed wages. Their nominal pay may rise, but it never rises as fast as housing, food, healthcare, or services. When wages go up 4% but living costs rise 10%, financial decline is inevitable. This fixed-income working class feels the dollar's devaluation most acutely. They work harder yet keep falling behind. Another losing group is anyone carrying short-term or variable-rate debt. They get crushed directly by rising interest rates. A loan at 5% can jump to 9% in months, sometimes doubling monthly payments. These people get financially strangled faster than any other group when the Fed tightens. On the flip side, every reset produces clear winners. Those who understand the flow of money and position themselves on the right side of history. Investors come out ahead. Those who own stocks, real estate, gold, and even large-cap crypto, assets that tend to rise with inflation, typically benefit when currency weakens. When the dollar falls, real and scarce assets often surge. That's why, despite all the turbulence from 2020 to 2025, the wealthy got wealthier faster than wage earners. Long-term fixed-rate borrowers also win big. Once their interest rate is locked, continued dollar devaluation makes their debt lighter in real terms over time. They pay the same nominal amount every month, but with weaker, cheaper dollars. Fixed-rate long-term debt becomes one of the most powerful anti-reset tools available. Businesses that own scarce assets win too. Companies with real estate, resources, infrastructure, or proprietary technology see their value rise as the currency weakens. And the clearest winners of all are those who understand reset cycles and reposition their assets at the right moment. They don't wait passively for the system to change. They prepare long before the rest of society realizes what's happening. The key thing to understand is that a reset is not just an economic event. It is a transfer of financial power. When the value of money changes, financial power changes hands. Those who grasp this end up on the winning side. Those who don't get swept away without ever understanding why. Resets have never been fair, but they always reward those who see them coming. If a reset is a silent redistribution of wealth, then the single most important thing for any individual is not to fear it, but to prepare for it. Because in every reset, winning or losing is not about luck. It's about how you position yourself before the system shifts, and to not just survive, but potentially thrive in the ongoing money reset. You need a clear strategy based on macro understanding and financial discipline, not emotion. The first step is to understand economic cycles and the signals coming from the Fed. Every Fed decision, whether raising or cutting rates, expanding or shrinking the balance sheet, is a clue about where money is flowing next. Winners aren't the ones who guess the market right. They're the ones who read policy signals before those signals hit the broader economy. When the Fed pivots, markets pivot. When the Fed removes liquidity, risk rises. When the Fed pumps money back in, assets rise. Understanding the Fed is understanding the economy. The second strategy is to shift your focus from holding cash to owning assets. Holding cash during a reset isn't safety. It's guaranteed erosion of value. Every month that passes, the dollar weakens a little more and quietly steals your purchasing power. Instead of hoarding cash, prioritize owning assets, things that can rise in price or at least hold value when money is losing value. That leads to the third strategy: concentrate on inflation-resistant and growth assets. Real estate, quality stocks, gold, and even large-cap crypto have proven over many economic cycles that they can rise with inflation. This isn't advice to chase risky assets, it's how you protect yourself from the dollar being diluted over time. Fourth, if you have or can take on long-term debt, lock in fixed rates as soon as possible. Fixed rates turn inflation into your ally. You keep paying the same nominal amount each month, but with weaker, lighter, lower real value dollars. This is one of the most powerful tools the middle class is rarely taught to use against a reset. Fifth, protect your retirement portfolio. Traditional 401 currencies, IRAs, and pension funds can be severely eroded if they don't grow faster than inflation. This is the moment to reassess allocation, increase exposure to long-term growth assets, and reduce low-yielding defensive positions. Failing to protect your retirement portfolio means handing your future over to inflation. But the single most decisive strategy, the one that ultimately decides whether you end up on the winning or losing side of the reset, is building an investor mindset. That mindset isn't recklessness. It's the recognition that hard work alone no longer protects you from dollar devaluation. Only when you control cash flow and invest properly can you make inflation work for you instead of against you. And once you understand this, you stop fearing the reset. You start using it. Because the most important truth of this era is that the money reset isn't something you can avoid, but you absolutely get to decide whether it destroys or upgrades your life. If you want to understand exactly how this reset will affect your wealth, subscribe and follow right now so you don't miss any of the next parts. And we'll see each other in the next video, where I'll keep revealing what is really happening behind the US monetary system.